Hi and welcome back to Siren Crypto. I'm Becky and in today's video we're going to be taking a look at Bollinger Bands. We will look at how they are constructed and how to use them to identify trades under different market conditions. Firstly, here's our disclaimer. This tutorial is for educational and illustrative purposes only. We are not responsible for any investments made applying this information or buying or selling recommendations. Siren Crypto are not licensed investment advisors. We make no recommendations to purchase or sell any kind of coin, option or security. Any investment contains risk and is 100% the responsibility of the investor to assess the risks and rewards involved. Trading the crypto market involves a high degree of risk and you may incur financial losses if you engage in this activity. We at Siren Crypto take no liability, assumed or implied, from your application of the information we share within our training programs. We've had quite a few requests to cover Bollinger Bands. It can be quite a complicated indicator for some, but it breaks down to a moving average and some volatility bands around that. Let's start right from the basics and look at the theory. We'll take a look at how they are constructed and what they actually are showing us in the market. Let's go through the idea of Bollinger Bands. They were developed by a chap called John Bollinger, so there's no prizes there for guessing where the name comes from. And what we have is a moving average first of all. We do have some videos on moving averages. So let's say we have a 20-day moving average. It looks something like this, and this is based off what the price is doing. Then we have two trading bands placed around the moving average, and these are the Bollinger Bands. We will show you this on a real market in just a few minutes. Firstly, we are just getting the theory down. These Bollinger Bands are mostly placed 2 standard deviations away above and below the moving average. Typically, we're using a 20-day moving average, and the idea of using this statistical concept of standard deviations is describing how prices are dispersed around an average value. Now, the average is the average, and 2 standard deviations is designed to ensure that 95% of the price data will fall between these 2 bands. As a rule, one way of using this is if the market price ends up at the upper end of the Bollinger Band, we can say it's maybe overextended. And then we could be expecting the market to sell off and maybe move to the low end of the Bollinger Band. So that's one way of doing it. People also use it as targets. For example, if they're buying down here near the lower Bollinger, they may be then looking for the market to roll back up and test the other Bollinger Band above that moving average. The basic concept is that we have a moving average and the Bollinger Bands that are placed at just 2 standard deviations away. Now, because they are based on price volatility, they won't stay a constant distance from the moving average. If volatility drops, the Bollinger Bands will get tighter because they're looking at what the price has done over the last 20 days. So if volatility or market movements get bigger and we see bigger swings, the Bollinger Bands will widen. The Bollinger Bands will expand and contract with what has been happening with the last 20 days of volatility. Some people think that when the bands are quite far apart at an extreme, then the current trend may be ending. Alternatively, when the bands have narrowed, the volatility is really low and maybe we're about to have an explosive move. So there we go, that's the theory behind Bollinger Bands. As usual, theory is one thing, but how it works in the real world can often be very different. So let's take a look at a couple of real markets with the Bollinger Bands overlaid on the chart. Let's take a look at Link paired with Bitcoin as our sample market, and we'll start with a clean chart, working in this case on a 1-hour time frame. We're going to add the Bollinger Bands here using the indicator tab and typing in Bollinger Bands. We can see the default settings here at the 20-day moving average and 2 standard deviations. And if you wish to, you can customize your settings. So there we are, that's our Bollinger Bands overlaid on the chart. Okay, so let's walk through some of this. The centre line, which I've coloured in white, is our 20-day moving average. And then either side of this, we do of course have our Bollinger Bands. You can see here on the left-hand side of the chart some sideways movements. The Bollinger Bands have narrowed, they're closing in on that moving average. Now this is a period of low volatility, the bands have narrowed, and the expectation is that we could get a big move when volatility increases. So you can see that the Bollinger Bands did a good job of providing support here. So if we're buying down here and possibly targeting a move to the upper extreme, we can see the volatility pick up and the price starts to move. Because this is based on volatility 2 standard deviations away, and we have our Bollinger Bands starting to widen. We can see as the bands widen, the price starts to move up. And when the market goes quiet a little, they narrow and so on. As I mentioned earlier, the band's idea is that they should capture 95% of the price movement. That's why we have them set at 2 standard deviations. Looking at this chart now, we could argue that Link has slipped below that 20-day moving average, and we've come down to almost test that lower Bollinger Band. Maybe one approach here would be to look at being a buyer as we are at the lower extreme. And we have some support back here with that lower Bollinger Band. And we're looking for the market to maybe rotate back up to the top of the Bollinger Band. So there you go. That's how they look on a real chart. To recap then, they widen at times of increased volatility in the market. And they narrow as volatility drops off. Well, I hope you can see the impact volatility has. Link on this part of the chart has been trading in a relatively low volatility environment. You can see though that it's grinding itself upwards. Then we see an explosion as the market seems to have fallen off a cliff. You can see how far now the Bollinger Bands then go out. They really are a function of how volatile the market is being. If we see volatility calm down, we will see these lines draw back in towards the moving average. We can see this sitting on the moving average, and if it drops and sells off back to the lower bands, some people may use that as an opportunity to buy in. They're looking for the market to rotate back up, and of course, the flip side applies. We can see the market rally back up to the top here towards the upper Bollinger Band, and we would be looking for maybe the sellers to come back in and the market push back down. This is a great example of how the Bollinger Bands are volatility based. Volatility exploded, so the Bollinger Bands get knocked really wide apart. Okay, well, let's wrap things up there. Hopefully you can see the impact volatility has and how this is indicative of the cryptocurrency market. We can see the bands get knocked out and come back together. Maybe Bollinger Bands would fit your particular style of trading, and on the next video we'll be looking at another approach to the markets. Now, here's a tip for you. I love anything that saves me time. If you think about the time that you spend trading, you can break it down into a few sections. The biggest section, I mean the one that consumes most of your precious time, will be technical analysis. By that I mean finding potential trades based on whatever strategy you want to employ. 100 Eyes gives us a supremely easy to use and very accurate tool for helping you find those trades and the qualifying conditions without you having to devote your attention to it. Instead of having to manually set hundreds of alerts on TradingView or flicking through countless charts, I just set a few easy parameters on the 100 Eyes platform and it does all that for me. This allows me to focus on the more rewarding parts of trading. The result is I make more trades. More trades means more potential profits. And that's what we want, isn't it? We are here to trade and make better profits. Now, 100 Eyes is not expensive to use and it just works. It will send you real-time alerts in Telegram. I've made a video all about using 100 Eyes. Just see the link below and start using it now and make your life so much easier. If you like this video, give us a thumbs up. Make sure you don't miss out on all of our videos by clicking the subscribe button. You'll get notified when our next lesson is uploaded. Well, I'm Becky. Thanks for watching Siren Crypto and I'll see you on the next video. Happy trading!